future. We're talking real money.
It's the bonus edition of Talking Real Money. Yes, we're into the bonus round. We have so many questions for you. The questions just keep pouring in at talkingrealmoney.com. All the typed questions. You know, we had a bunch of questions that were left over from Retiremeet a while ago. We have questions. Well, I take that back. You have questions, and we are hoping we have answers. Now, I have not as yet seen the questions, so all my answers
hermetically sealed right here.
Yeah. Tom has seen the questions, giving him an obvious advantage over me, which he does. He does, which is what he does because he wants to be liked more by the audience, which so far is working for him. I was looking at the reviews. It's so funny. I'm the lightning rod because I say all the really edgy stuff. You know, you on the other hand, do you ever really just slam crypto? Do you? No, you really don't.
Funny. I was just thinking about that.
You dance around it.
I know. People be like, well, how's Tom feel about this? He never says anything. Don't know how Tom might run for political office or something. You won't know what I really think about anything.
Don's an idiot, but that Tom guy, really intelligent. I don't know what he said, but it was really intelligent.
We've talked about the reasons why. I'm a middle child. That's what middle children do. They get along with everybody. That's just
we can speak of it again. Oh, before we get to the questions.
Yes.
This is great. This is a terrific example of the state of the financial advice industry in America. In my little town, I
love that song. Yeah.
My little town here, Celebration, Florida. Some folks in town have these little back porches on Facebook where people ask questions and leave comments and such. Well, this morning I saw a question from somebody here. I'm going to read you the question verbatim so I don't mess it up.
While you're pulling it up, somebody asked me about your town at a recent event, and I said it's like the town in the Truman Show. It
is, sure.
Very similar.
Yeah.
But you're not Truman, just so we can be clear about that.
This post says, I made a post, but I can't find it, so I'll ask again. Best financial advisors in the area? Thank you. Okay, so people in town,
let me guess,
suggest financial advisors.
I can go through the list.
Let's see. I bet you get two of the four correct. I don't think you'll get the other two. I think you get two of the four correct.
One is Ed Jones.
Oh, nailed it. Yes, that was the easy one.
Too easy.
Okay, what's the other one? You should know this one. You
Merrill?
should know.
I'll go with Merrill.
No.
Bank of America thing.
No.
From there,
you're a little
I don't know.
highfalutin. You're a little highfalutin on your choice. Go more mainstream. Go more in the Ed Jones area.
I don't.
LPL.
LP. Because people.
Every independent.
But they often use another name like Don McDonald, a part of LPL.
These guys use Good Life as their name, but they're a part of LPL, Good Life.
The largest, I think.
They are the largest.
Broker-dealer, they're big. Big.
And then the other two, one of them you might have heard of, which is Cetera.
Sure. Yeah, they're around,
And then the other one, you've heard of the main company, but did you know that Farmers has a financial wing? Farmers Financial.
Oh, God's sakes. Yeah.
So what do we have? Broker-dealer, insurance company, broker-dealer, broker-dealer. Those were the four suggestions. Then Don suggested.
Oh, you went online. You couldn't help yourself, could you?
I could not help myself. I said, you must carefully vet advisors. Now, apparently, I'm going to make a lot of enemies, but that's my job. And that's why I thought of this, because this is what I'm good at. Most are still commission salespeople. Make sure you get a fee-only 100% fiduciary. That means no commission product sales, securities, or insurance. Read everyone's Form ADV Part 2B at advisorinfo.sec.gov. Look carefully at fees and conflicts of interest. For some helpful info, go to talkingrealmoney.com/help. Finally, avoid equity-indexed annuities or similar insurance investments like the plague.
And any response to that so far? Have they
Not a one.
Then somebody will, though. They'll say, well, but Bill at Ed Jones is like the greatest guy I ever met.
Yeah,
Come on.
It's not Bill. I think it's Daniel.
Oh, whatever. You get the point.
I got the point. Anyway, this is the sorry state of the financial services industry
horrible.
in America.
Absolutely
it is
horrible.
Terrible. And the fact is, I can't even think of a fee-only advisor in town.
There's got to be somebody. Well, there certainly isn't Orlando. Maybe.
Yeah, but I mean, in our area, but look at the number who live in town, who are my neighbors, who are commissioned sales folks. And there are many more than that. I know a lot of others.
They live there because they made a lot of money selling commissions products. Sorry.
Anyway, I bought in when it was cheap. I bought in here. I did. I bought in 1996. So when it was cheap.
Good for you.
Anyway, moving along.
Yeah,
it's Q&A day.
Here we go.
It's a special Q&A edition. Go ahead. Give me
and
the
some
question.
of these are from recent Retiremeet, but this one came in separately from John in Dayton, Maryland.
Does it matter, really?
But we got it again from Retirement, and we got it again, so I figured we got to answer this. Ready?
Right. Yeah.
Why keep bond index funds in our allocations when 10-year performance has been so poor? He went through, he talked about the Vanguard Total Bond, Vanguard Total Bond Market ETF, Fidelity Total Bond. Their average performance, for the last 10 years, 1.61%. Why keep them in? Why should we think the next 10 years will be different from the previous 10? And then somebody else wrote, why keep bond index funds in our allocations when the 10-year performance has been so poor?
Well, apparently, I'm trying to, how do I do this nicely so I don't get nasty reviews?
You just said you're a lightning rod, so go ahead and light it up.
Apparently, you guys aren't listening. You're just not listening. What have we said about bonds? Oh, have we said, go out and get a good bond fund to make lots of money? You want to have a bond fund in your portfolio for that hefty income stream. Have we ever said that?
Not to my recollection, no.
What do we say? Why do you own bonds in your portfolio? Is it for the return or?
Bonds for the stability, bonds for the buoyance, bonds for the fact that they're such a different security than stocks and have been far less volatile than stocks for a very long period of time. I know 2022, we had the 1 year everything went down, right? So everybody thinks, well, bonds don't work anymore. And here's 10 years of performance, Don. They haven't worked for 10 years.
All of which, that whole 10-year number was influenced by that 1 year of losses.
Huge.
Because bonds don't make much. 1 year of small losses when compared to the stock market. And by the way, the losses in the bond market when compared to a worst case scenario for stocks. Is nothing. What you should be jumping up and down going, oh, look, my bonds didn't lose me money over 10 years because stocks have.
They've had 10-year periods. So, I mean, again, two things here. Number one, do I expect the next 10 years to be different? Yeah, because every 10 years are different.
Okay, let me just qualify that.
I'm not saying it's going to be better or worse. I expect it to be different than the previous because every 10 years is different.
Well, maybe. Yeah.
I mean, but looking back 100 years, bonds have done what you would hope bonds would do as an IOU. But so we're not changing. No, we still believe in using bonds. But here's the other part. Let's assume that you're right. Bonds are horrible. Bonds have been horrible the last 10 years, going to be horrible the next 10. What are you going to do instead? Are you going to put it all in stocks and then see your portfolio go down by 50% in the next big downturn? I got to wonder.
What is your option?
Yeah, right. Where are you going to put the money instead?
Is it crypto? Oh, wait. No, that's not steady.
Is it gold?
Not steady. Bonds have proven to be steady. They have. And that 10 years actually illustrates that they can have the worst year. And I do believe that was the worst year the bond market has ever had. They can have the worst year in history and still over 10 years have posted a positive return. That actually speaks more than the fact that they haven't done as well as they've done in the past. That tells you that we're right. They're a relatively stable asset.
Keep calm, stay bond is my take. All right. Another question. This one comes from Bob in Marcellus, New York. Here's an alternative for you. He says, is there anything positive about structured notes?
No.
Negatives, he says also. Positive or negative. Structured notes, which can be a little hard to describe, actually.
They're complicated. They're incredibly complicated, and they're designed to be complicated. So what it is, it's okay. I'll make it really simple for you. A structured note. Now you're going to know this word. Think about it. If you've lived for more than 25 years, you're going to know this word. Derivative security.
Well, that should make you nervous if you've lived more than
Okay.
25 years.
They are derivative securities. They are complex securities that have other things in them to cause the structured note to do something different at times than the underlying security, which is typically a
Wait,
debt
that's your
security.
description? It is a debt security, right? I mean, this is a note.
But they can add an equity component to it to boost returns. They can add hedging to it to try to protect, to hedge against losses. The literal dictionary definition of a structured note is a hybrid security combining
that's the word I was looking for.
Different financial products into one thing. And I believe they exist for one purpose only, and that is to obfuscate, to reduce investment transparency, to baffle you with lots and lots of BS and fine print.
Yeah. And again, is this something?
And make Wall Street money.
Yeah, I was getting to that. I mean, is this something you need in your portfolio? And our suggestion is going to be no. This is something that is sold. This is something that you don't see it much anymore. It feels like haven't heard much about them in 20 years.
Well, because the stock market has done well.
Yeah, I guess so.
So you don't have the big concerns. Also, it's really, as Tom said, it's not one of those things where you go, "Hey, financial planner, can you give me some structured notes?
Yeah.
I've been jonesing for some structured notes."
That right there on the plate next to the French fries. So we don't have very many positives on that, but a lot of negatives. Here's a question from recent Retiremeet. Trying to get through a few of these. Should I move my 401k from a previous employer to an individual retirement account or IRA?
Generally speaking, and I do mean very, very broadly speaking, when you've left the employer and you are no longer a contributor to the plan, moving everything into a single IRA account with a custodian that offers a wide variety of securities is probably a better way to go. It's going to give you more options, and it's going to give you a better sense of control. You'll start to look at your portfolio as one entity instead of separate pieces and parts, which we tend to do. We look at our 401k and our IRA and go, those are two different portfolios, when in fact they are your tax advantage retirement portfolios. So they're basically the same thing. The other thing is that sometimes 401ks have really cruddy products in them.
Yeah. And so you said it correctly. There isn't one right answer. But for example, if you're leaving an employer and going to another employer, oftentimes it makes sense to take it to the new employer for a couple of reasons. Number one, then you only have one account. I see people, you coined the phrase
biggest issue.
Hodgepodge. Well, that's not the biggest, because if you move money to an IRA and you want to do a backdoor Roth IRA, you can't do it anymore because you have to move the pro rata amount. That's what I'm saying. You get into all these little rules like, what about that? What about that? So it makes then more sense to just have it all in a employer-sponsored plan, so you can still do that backdoor. Remember where you move the money to the IRA?
That's why I had to speak broadly.
Yeah,
because every time we speak broadly, we answer broadly, we get nitpicky.
People will write us and
what
say,
if?
Yeah,
I know there are always what ifs.
And here's
do you know how long this show would go if we gave you every what if? I mean, we once got a note from compliance that said define every term. Do you know how long this show would be if we had to define every term?
We'd have to have Paul Merriman on and let him go on. But anyway,
6 hours later.
The thing is,
6 hours later.
The only other thing that makes me a little nervous about this is when you're moving money from the 401k to the IRA, you got to be careful. If you don't know what you're doing, I see people that either they take distributions sometimes instead of direct rollovers. They get put into products. They get sold into stuff that annuities, high expense, that they just don't know enough to say no to. So remember, you got to know what you're doing. You got to be careful in that moment, because that's a big, it's a huge financial decision for you that I do worry.
Often the salespeople are out. They're hovering. When you're retiring, leaving a company, they're out going, 401k into my clutches.
Roll over, baby.
And the other thing is, let's talk about the terminology here, because there is some confusion on terminology when it comes to this. A rollover, technically, is when you take a cash distribution and then you roll it over into an IRA. That's where you can get into trouble. You want to do what is called a direct transfer.
That makes
is
sense.
from custodian to custodian. You never take possession of the money, so you never accidentally end up with a taxable distribution.
Yeah. Want to avoid that if at all possible. So again, do we favor that in a general sense? Yes. Should you be very careful about it? Absolutely. And know exactly how you're going to invest the money. So
broadly speaking.
Yeah, broadly speaking. As Don sometimes says on this program, it depends. So
it's the right answer.
It is the right answer. Okay, this one's got a little bit more to it. This comes from Tony in Plano, Texas. He's writing about his retirement plan. Wife and I are 53 and have $1.8 million in cash and CDs.
What?
We're getting to that. Hang on. $1.4 million in a 401k and $400,000 in a Roth. Okay. Our desire is to retire at 56 and they'll need $80,000 to $90,000 a year. Plan is to maximize ACA subsidies by keeping income low, living off cash until age 65. From 65 to 70, we'll live off cash and Roth and do 90K Roth conversions each year to minimize our RMDs and stay under IRMA. At 70, start Social Security, live off that and 401k the rest of our lifetime. That leaves us play and cushion money in the Roth. Am I crazy, writes Tony, to keep $1.8 million in cash so long? If I move it to brokerage, it would impact our ACA subsidies. Thoughts on this plan?
Oh, again, it's
very specific.
Another. This is a tail wagging the dog kind of thing again. We're so worried about saving a little money that we're leaving potentially big money on the table.
Huge
think about the difference. $1.8 million. The difference between 4% per year and let's say 7 or 8% per year.
Even 7. Year after year, and you're only 53. Huge difference.
I without even running the number, I can tell you it's far bigger than your ACA differential.
Which you want to explain what ACA is?
The Affordable Care Act.
Right, correct.
Because you get subsidies at various income levels. We're so worried about giving up, like, oh, I don't want to pay taxes. I'll make less money. I just don't want to pay taxes. Or I want the deal, so I'll make less money. It's the old Ben Franklin thing. Penny wise.
Well, and in this case, you're leaving half of your assets in cash.
It's a horrible idea.
No, it's very bad. And at 53, wow. I mean, you're not going to keep up with inflation.
Well, think about it. 53, you still are on that 1.8 million with all your other assets.
Yeah.
You can be in stocks pretty heavily because you've got 2 decades.
I would be a lot in stocks there to have that Roth 100% in stocks.
Yep.
400K. And in the riskier stocks. So, no, you've got it backwards to me.
Tony is the perfect example. We talk about this. There are people who should be doing it themselves. Absolutely. When you're getting started, you can't afford an advisor, and 2, you don't need one. But when you get to this point in life where you have now saved and scrimped and invested and really worked your tail off to get to the point where you can retire early and comfortably,
which is awesome.
You can't afford to mess with it anymore.
No, I agree.
You can't afford to play games or fly by the seat of your pants. This is why you need a plan, because a good planner, a good fee-only advisor is going to look at your numbers and say, sir, this is the difference between your ACA deal and the money you could be making in the market. Are you willing to give that up?
Substantial difference between those two, I would think.
Yeah, define your terms, sir.
Pardon me. Delta, not the airline, by the way. Yeah,
Delta. I flew Delta.
I know. How was it?
I really like Delta. I do really like Delta. I think they go out of their way to make flying.
And you use the comfort class, right? The
Comfort Plus. Yeah. Although when I was looking up front, right in front of me, I mean, honest to God, the next seat up, I kept going, maybe it is worth that $300 extra. I
tell you what, when we go back east for the next Retiremete, I'm going to use
particularly on the 7-hour flight coming out here. The jet stream was so strong that it took us 7 hours from here to Seattle from Orlando, but coming back 4 hours and 10 minutes.
No.
Yes.
Wow. That's
4
crazy.
Hours and 10 minutes.
Woo. That's good.
We were hauling.
Wow. That's really solid.
We got out late and got in a half an hour early.
That you never hear that in the airline industry. So congratulations on that.
Thank you.
And the door stayed in place the whole time.
It was an Airbus, sir.
Oh, okay.
I looked it up. Do you know Delta doesn't fly 737 Maxes?
Not
They
at
don't fly
all.
them. Not at all.
They fly any 737. I got a few 737s.
I think they probably have a few old 737s, but no Maxes.
Oh, okay.
They're all the Airbus Neos.
Oh, okay.
Which is a nice plane. I hate to say Boeing.
Let's not do that. Okay. Final question.
Nice
This
plane.
is it. This
Okay,
is
go ahead.
it.
Yeah.
From Greg in Chico, California. He says he recently moved his short-term money into the Fidelity Government Money Market Fund, SPAXX, in a Fidelity brokerage account, using it as a checking and savings account. Earns 5% of the money, can pay all his bills automatically, write checks, has access to a debit ATM card. I know that money market funds are not FDIC insured, but are considered pretty safe. I know there have been a few instances where the money market funds have broken the buck. I think it's only 2. And I was hoping you could explain this so I fully understand the minimal risk I'm taking by having my money in a money market fund instead of an FDIC insured account.
Okay, while we're not allowed to say this is riskless, darn it, this is so close to riskless.
It really
you can
is.
hardly see the light between riskless and this. It's like, you know what? Dove soap was 99.999% pure.
Something. Yeah.
This is like 99.999% safe.
But so explain what government, because when people see government money market fund, what securities do they hold in that account?
Let's start with a regular money market fund. A regular money market fund will hold very short term, overnight or a few days or weeks, government paper and commercial paper. Short-term paper floated by corporations at a
to meet
slightly
payroll. Big companies do this stuff. Yep.
And the corporations pay slightly more to borrow because they're slightly riskier, but the terms are short. For example, the number one security, and let me see if I can find anything else in here. No, I can't. The number one security, in fact, I think it's the only security in the Fidelity government money market, are T-bills.
That's got to be it then. And generally they've paid you back, I think, right?
And I'm looking at, this is hysterical. This is the latest report from Fidelity, and I don't know when that comes out. I assume it's as of, I don't have as of the end of January 2024.
So a little over a month ago.
Their number one holding was a 1 month T-bill.
So unless something happens to the government by the end of March, you're probably in good shape then.
And they default. That happens to the government. They don't pay any of their bills. And this is the number one. By the way, this is the number one bill they have to pay. This is top on the bill pay list.
Yep.
This is a full faith and credit obligation of the United States. If we fail to pay on our Treasury securities, what was that Argentine note how much was that paying?
99-year Argentine note.
What was the rate on that?
It was 30-something.
30-something percent.
Yeah,
that's what we would be a northern banana republic. We really would.
And by the way, if you want to feel differently all about that, then we're rewatching John Adams with Paul Giamatti. You look and think,
when we were a banana republic.
Yeah, these people are going to pay their bill. Maybe we might not. Anyway, so it's worthwhile. Thank you. That's good stuff. And so the short answer is
super, super safe.
I love the way you're doing that. So keep on doing it. I think it's good stuff.
I've thought about something similar. Because I'm with Bank of America.
Right,
it makes sense, but
I just try to keep so little in my checking account that it doesn't matter.
The problem is I have all of these bills all set up
that are bing, bang, boom.
Bank of America.
Yeah,
I don't have to think about it. They're all done for me. So the fact that I make no money on my checking, while it bothers me, I sometimes sit around and go, is it worth the bother?
My wife thinks it's weird that after everything gets paid every month, we have like $200 in the checking account. I go, I just don't keep anything there. Sorry, it's gone. Right. It's gone. Sorry. Good luck.
Yeah, I have it in my bread financial savings account.
It's rising like bread, right?
Yeah,
okay.
My bread is rising.
Good stuff.
All right.
We still got a lot more questions, but we will try to take them up at another time. That was like 1/8 of them.
We're going to have some more bonus question shows.
Lots of bonus, but we'll just keep them coming. They're good stuff, and we appreciate them also. Feel free to write us anytime or call Don anytime.
Well, you don't call Don. You go to talkingrealmoney.com.
Sounds like they're calling you.
It does, though, doesn't it? Mm-hmm. And the quality, I got to tell you.
Amazing.
the phone calls sound like crud. They do. The phone calls, when you guys call, they sound terrible. But when you do it through your computer mic or your iPhone mic over the internet, they sound really good.
Yeah, they're very clean.
So go to talkingrealmoney.com and click the contact form, and then click the little microphone button and record your questions. Then I answer those on Fridays, with probably an occasional bonus day as we're getting behind on those too.
Yeah, there's been a lot. Got a lot coming in. So keep it coming. We're glad to help any way we can, and thank you for being part of the program.
Thank you so much. Take care of yourselves. I'm Don. Tom is over there, thousands of miles away, but still there in spirit, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?